There are different equity structures and types that could really work for almost any doctor. It's just a matter of figuring out what those motivators are and providing that optionality.
You have a pretty unique approach, almost a more holistic approach with not just, hey, let's get a deal done. Talk to us a little bit about, what differentiates these types of deals and, how do doctors work through that with your approach in particular with the end in mind?
What we need to do is...
All right. Well, hello, everybody, and welcome to another episode of Office Hours for Practice Owners. I'm Justin with Marti Law Group, and very excited to have a couple of great colleagues on here today. We are going to talk all things dental transitions, covering the DSO side, covering kind of the private or doctor-to-doctor type of deals, and really market conditions and what's kind of driving deals today. So without further ado, I've got Matt Sutton and Andrew Kobylski of McLerran and Associates. McLerran, for folks that don't know, is a fantastic sell-side brokerage working on all types of deals, transactions, very specific to dental. We've had the pleasure of working with them. I've known these guys for quite a while, so it's an honor to have you both on, and love to have you introduce yourselves. Matt, if you want to go first.
Yeah, Justin, absolutely, and thanks for having us. Obviously, you do great work in the space, and the size of the dental space, right, and being up there in the Northeast and nationwide. Thanks for having us. Yeah, so my name is Matt Sutton. Prior to coming, I've been in McLerran for 2.5 years. Prior to McLerran, I actually was instrumental. I was a vice president of business development and helped build the orthodontic DSO on the East Coast. Pioneered us getting into some of the harder states to work with, North Carolina being one, Mid-Atlantic all the way down to Florida. So really, working that market, understanding the buy side, having sat across the table from, sell side advisors, doctors who may not have proper representation, and just understanding, getting their mindset as to why they might be going into a sale. And then prior to that, I was a broker at one of the larger brokerage firms nationally, and I did quite a bit of private doctor-to-doctor transactions. So definitely understand that side of the business as well. I did that for a number of years. And then prior to that, I was a dental and veterinary banker in the space. And I've helped, probably 1,000 dentists do startups and acquisitions on the finance side. So they're the new owner. And then at this point in my career, I've actually been able to help a couple of them exit out of their businesses. So I've seen the life cycle in the business. I love the business. I mean, it's a great industry to be in. And there's a lot of really good people in this industry. There's some bad actors, but for the most part, the dental industry stands on its own. There's a lot of good people, a lot of good integrity in that space.
Awesome. Andrew, I'll throw it to you.
Yeah, absolutely. Thanks for having me as well, Justin. Prior to coming to McLerran, I was actually a wealth advisor for dentists, helping them focus on retirement planning, investment strategies, tax and estate planning, kind of the holistic approach to their personal side of the business and planning for their retirement and their future there. Coming over to McLerran about 2 years ago, I switched over into the practice valuations and transitions side and have predominantly served on both the private and the DSO teams here, although we obviously work and look at everything from both angles, right? And we'll talk a bit about that more here, I'm assuming. But a lot of my experience, I've only ever worked in the dental industry. So since coming out of school, I've been in the dental industry, whether it's on the personal side or the business side, I can kind of look at things from both angles. And a lot of times I've found that that's been helpful in getting the transitions across the finish line in a way that's optimizing their exits.
Amazing. All right. Well, gentlemen, thank you both. Yeah, I'm really excited to dive in first, I think a little bit more about McLerran, because I find that in having worked together and gotten to know you guys, I think you have a pretty unique approach, almost a more holistic approach with not just, hey, let's get a deal done, right? Like you've worked with clients for a number of years, you get to know these folks. Yes, an exit is part of that life cycle, like you talked about, Matt. But I think it starts much earlier in working with you guys, and there's just a different relationship that I've seen. So, whoever wants to kind of kick it off, but talk a little bit about maybe the background, McLerran's philosophy.
Yeah, I think that's a great starting point, right? I think if you look at it from the business side of it, I mean, this has been a family-owned business for 35 years. Paul McLerran started the brokerage firm 35 years ago in the state of Texas. And the current owner, majority principal owners, Brandon and Ryan Moncrief, are brothers. And they were actually bankers as well, and bought the firm, I think it was like 2011, 2012, something like that. And they actually bought it from Paul McLerran at that time because they were bankers and they saw that the industry needed good, high quality brokers to come in. And Paul was getting to the point where he was retiring and wanted to be in Austin. They were in Houston. They talked to Paul, and the son of the business didn't want to carry on the legacy. He was successful in entrepreneurial in a different facet. And so Brandon really, he was the entrepreneur that kind of came in and took the brokerage firm from being a very small mom and pop shop to now what is now a national firm. And we have offices, our headquarters is in Austin, Texas. I'm in Atlanta. We've got one in Cleveland, Ohio. We've got an office in LA, soon to be an office with Andrew moving to the Mid-Atlantic. So, I mean, we are truly a national firm, and we service not only the private side, but also the DSO private equity investment banking side, which we'll get into and how we do that. And we do it comprehensively. We provide a very objective view. I can't highlight the team enough at McLerran. So, you've heard my background, the owner's background, very similar, dental banker, entrepreneurial, came and bought the business. COO is a licensed CPA, engineers all of our valuation work, all of the documentation that we use. Everything we do is in-house. I think that's a very important thing to state here. A lot of our competitors outsource their valuations. Some of the, less well-known groups, they throw a lot of stuff against the wall, hoping that the valuation methodology will stick when they bring you to market. Everything that we do is done in-house. It's all defensible. We make sure that we vet out the business entirely before we bring it to market, because we don't want to leave any stone unturned that could later cause, angst or anxiety through a process that we didn't proof out on the front end. Now, is there a miss once in a while? Sure, but it's very rare. And so, everything we do is very defensible for the client. And then early on, when Brandon, and Ryan took on the business, Brandon was on the forefront of underwriting the investment banking space. So he started DSO transactions 2017-ish. And so he was on the forefront before the boom really happened, 2020 to 2023. So a lot of depth on our bench, great team, can't say enough about it. All of our underwriters come from, large institutional houses in the dental space. So very fluid in the space, and I stand by our reputation, nationally for sure.
Let's touch on, your approach further, I think, because there is kind of this, determination, I think, that a lot of docs have to make, right, when it comes time to exit. Sometimes, you kind of alluded to before, the DSOs may not be targeting a certain geographic area. Maybe the practice just doesn't have enough revenue or EBITDA to draw attraction. But a lot of times there is kind of this, they've got to figure out, hey, am I a doc who wants to sell to an associate or to a third-party dentist, or am I, want to go this DSO path and everything that comes with it, right? And life after those transactions can look really different. There's a number of nuances to each side. So I don't know, Andrew, if you want to kind of take a stab at the first go to talk to us a little bit about, what differentiates these types of deals and, how do doctors work through that? And again, with your approach in particular, with the end in mind.
Yeah, absolutely. And I think you hit on a very key point, which is that we're always keeping that end goal in mind. And through our process, whether you're coming to us, wanting to sell tomorrow or wanting to sell in 10 years, we are then looking at that end goal and reverse engineering the pathway to reach that goal. When a client comes to us, we take a fiduciary approach. And the reason why I say fiduciary is because that's the term that we would often use in the financial advisory world, right? It's not about me or my preferences. It's about you as the doctor and what your goals and what your preferences are, what's best for your family, et cetera, right? And what we need to do is not necessarily sway you one direction or the other, but provide education on each option and each pathway you can walk. So that way you understand the pros and the cons, what's going to happen, how it's going to happen. And so you can feel empowered to make that decision, whether you decide to sell private or you decide to affiliate with a DSO or a private equity group, because there are pros and cons of each. And we'll kind of talk through both of these, I think, between Matt and I. But I mean, there are absolute constraints between both options, whether it's the valuation metrics, the post-sale workback expectations, the tax implications. I mean, these sales do differ pretty noticeably in a variety of ways. And so getting fully educated before you even list your practice and taking the time to understand your value in both markets is imperative for having a successful transition.
I would agree. I think one unique thing about McLerran is, we objectively, and you'll hear the word objectively a lot through this presentation, Justin, but we want to make sure that when we have a client or one of our long-term relationships with a doctor, right? I mean, doctors often come to us years in advance looking to get evaluation done just to understand what their business looks like. And we'll look at the KPIs and make sure, performance is where it should be, margins where they should be, so that we can help them prepare for a sale, whether it's 10 years from now, whether they're just looking for the legacy of their business or they're looking for an immediate sale. We're here to help with that. oftentimes when we're going through the planning and we're having the dialogue with the clients, we're helping them kind of define what we refer to as their why. Why would you be looking to go to a market sale? What's going to make sense for you? How much more runway do you have? Because it's a very complex thing. We see a lot of people enter the space and, they're trying to be advisors or brokers and they think it's very transactional and it's really planning for that legacy of the business, which I'm sure you have long-term legal clients and it's like, is the timing right? Or did a life event happen? Or, it could be as simple as I've helped doctors in their 30s sell their practices where, they just ended up being really good business owners and they don't want to be business owners. And all of a sudden that wonderful practice that they had, put their state flag in the ground, stake in the ground, they're getting the practice going, turns into a $3, $4, $5 million practice. They've got 3 young kids at home that they're not seeing and they're doing clinical and after hours, they're doing all the payroll and they're doing the marketing and they're doing all these things. And they recognize that they built a great business. However, it's consuming them. And so it's, hey, what are my options? Because I'm only 35 years old and I've got another, 20, 30 years of clinical. And again, that's just one very small example of the many different scenarios that we come across. And so, that's where we help them define, maybe the right DSO partnership would be good for you. Maybe an outright sale of the associate and you become the associate, depending on if that's a viable option, being able to finance it, the size of the business. Key man risk is huge in these deals. So understanding where their key man risk lies within the practice and the business, and if they've kind of diversified themselves out of that a little bit, and some of it falls to the associates, or the associates on board. So there's a lot of methodology and thought process that goes into this. So when we do a valuation for the doctor, we're having these conversations on the front end to say, hey, what's the driver in you having this conversation? I would say 90% of the time, Justin, we've got to help kind of put the guardrails in and give the help, show them a path and get them to understand why they're even having this conversation. Does that make sense? I'm sure you've seen it.
Absolutely. I mean, it's funny you mentioned there's a lot of brokers entering the space and I see a lot of attorneys, right, turning to brokers and obviously lenders turn to brokers. And it's just amazing to me because I've learned being in this space that it's not as transactional as folks think. They figure, hey, I'll make an introduction and, go hang out for a few months, let the lawyers hopefully not blow it up. And then we close, and I've realized how much that's not the case, even for the lawyers. I mean, frankly, there's attorneys who probably, push the paper back and bill as much as they can. But, myself, having been on the founder side of starting DSO, scaling it up, probably right about the same time I think you had been working with your group, actually in similar geos, I think we were, both scaling your group up. There's just so much more to it. And so I think, that relationship component that you guys focus on is pretty unique.
Yeah. Well, and I think, Matt, you hit on a really good point here regarding the why. A lot of people think that this is just purely an economic decision. Oh, if the 5-year economic value makes more sense in the DSO space, that's what I'm going to choose. Or, vice versa for the private space. The problem is that probably 50% of the decision is economic with most of our clients. There is a qualitative aspect to these transactions that if you do the appropriate amount of discovery and digging on the front end, you actually uncover a lot of underlying drivers behind whatever decision a client makes. In the private sales, it's a little bit more clear. Oh, I need to retire. I'm ready to hang it up. I need to relocate. My spouse needs to move for their job. Sometimes it's burnout, right? It's a little bit more clear. In the DSO space, when you're actually looking at it from both angles, it becomes a little bit more complex, right? A lot of times there's a fear surrounding private equity or the DSOs coming in and taking over everything, and then they lose the grip on their practice, for lack of a better term. There's also just the overall desire to relieve managerial duties, but you still love the idea of practicing every day, right? And so on the front end, while the valuation, it gives off a very quantitative connotation, in reality, it's probably 50-50 quantitative and qualitative. We're often digging into, again, the underlying drivers of what a client is looking to achieve. And we're cross-referencing that with the economic impacts to help them make the best decision. Because you have to look at it, there's a yin and a yang there between the economic and the qualitative that you have to align to actually find that right strategy. Otherwise, the client's going to be unfulfilled post-sale. And that's the thing that we want to avoid. The last thing we want is for an unhappy client post-sale to feel like they didn't do it the right way. And that's our value add.
One of my favorite books, right? Simon Sinek's Start With Why, right? And so often the exit is such a reactive thing, right? Rather than a proactive, what is my why? Can I do 5 years working when I'm not the owner, right? And, I always tell them, hey, look, when we close the deal, you walk out on Friday, right? You're the owner. You're walking on Monday, it might feel a little bit different. So can we stomach that? And I've had to do that myself, right? So anecdotally, I think that philosophy makes sense. And go ahead, Matt.
No, I was just gonna say, I think it works as the reverse too, right? Like you have a buyer that comes to you and they're working with the legacy doctor, and the legacy doctor, maybe they're anti-DSO. Maybe they decide, I don't want to go corporate, I don't want to go private equity, and they're looking to sell to an associate, but they want to stay. Well, I mean, that associate could exit that legacy doctor, within 6 months, right? Cash flow is king in those deals, and they need to be able to, cash flow the loans, cash flow the rent, cash flow the payments, and make a living, and so on and so forth. So we have to really take an objective view in every single transaction that we look at. Private, DSO. We also, we have clinicians that come to us and they're like, anti-DSO. Well, talk to me a little bit about why that is, right? And it's, do they fully understand the different equity types that are available in the marketplace, a joint venture versus a holdco or a blend, so on and so forth? Yes, you are going to probably give up majority ownership of the practice. However, are you sharing in the same mindset of what one DSO is versus another DSO, right? So there are different equity structures and types that could really work for almost any doctor. It's just a matter of figuring out what those motivators are and providing that optionality and showing them as we're shepherding them through the process, saying, hey, here's what's available to you given the current market conditions in the marketplace. And let's explore all these and if they would make sense for you. So then we would go and we walk through every client and we let them hear the story from each, single buyer, from somebody that's looking to buy it all the way through the full scale of the different, investment banks, DSOs, so on and so forth, to see what makes the most sense for that individual seller. Does that make sense?
Yeah, absolutely. And you alluded to it before, and then just again now is really market conditions being a big driver of options, right? And optionality. So, let's dive into that if you guys can, a little bit about what the current market, we were in the gold rush, right? 2020, 2021, we saw it. It was just, people were grabbing units as quickly as they could. And, we've seen some groups, maybe they move too fast, right? Which can happen. And so they've had some troubles. We're in a weird kind of economic, political, environmental situation right now where some folks, PE groups, have pulled back a bit, right? So what do you guys see on both the private side and the DSO side as far as like what the market feels like right now?
Andrew, why don't you start with that on the private side and we'll upscale in through private equity?
Yeah, absolutely. I would say the private market has never been stronger. We work nationally, whether you're in Los Angeles, DC, down in Florida. We hold all of our licenses. So we operate on a full national scale and do, over 400 valuations on a standalone basis per year. So we have our pulse on the market in almost every pocket of the country. And the number one thing that I can tell you is since COVID, private practice valuations have continued to increase. Part of this is just natural, right? You have inflationary pressures driving up fees, driving up cash flow. So you're seeing a lot, higher valuations as a percentage of collections, though that's not necessarily the primary driver of a valuation. And at the same time, the DSO aspect has increased valuations in the private space, right? And the reasoning why is because the banks, to compete with their main competitor, which is practices being acquired by DSOs and private equity groups, in order to make private practice seem more attractive and continue to keep private practice healthy, have had to up what they are willing to lend as a percentage of revenue to entice people to continue to operate on a private practice basis. And so you've seen, what was, say, an 80 to 90% percentage of collections valuation range increased to 85 to 95, 90 to 100. In some cases, we're seeing valuations above 100% of revenue. So, overall valuations have continued to increase. And I would say we're still in what I would call a seller's market. I don't foresee that changing. That's going to be a secular trend. There are always going to be a lot more buyers than available practices. Luckily, the startups have, also continued to proliferate in certain regions of the country, even though those costs have gone up, but acquisitions still remain strong. If, a practice doing above $750,000 in collections with $250,000 plus in cash flow with 4+ operatories in a strong geographic region with at least moderately equipped technology and equipment, those practices are flying off the listing board. We're seeing average time to close between 3 to 6 months right now for those practices, sometimes quicker, depending on if you have a cash buyer, because you don't have to go through the bank underwriting process. But for the most part, 3 to 6 months is what we're seeing for those strong practices. And even if you say have a more rural practice, more unique practice, procedural mix is a little bit more diverse, harder to find that person to come in and replicate, there's still a healthy amount of buyers, especially if you have healthy cash flow and a buyer can re-engineer the business to be profitable following the transition, regardless of what they can and cannot replicate. So overall, we're seeing a ton of buyer demand. Sellers have never been in a better position in the industry to sell. The biggest thing is again, getting that valuation 3 to 5 years ahead of when you actually want to go to market. So that way we can identify where you're efficient, where there's low-hanging fruit to improve operations, and then also letting enough time occur between the valuation and your sale date to actually let those operational changes occur. And for those operational changes, the financial impact coming from those operational changes to flow through into the financial performance. Because a lot of people, I get a lot of significant others of doctors who come to me and they're like, this practice could do so much. We're not operating at full capacity and we need to value this higher. And they treat it as if it's a tech firm or a tech company where everybody's basing off of valuations off of network effects and future growth multiples and all these various key metrics. And the problem is dentistry is not forward-looking from a valuation perspective. It's very much current and backwards looking. It's what you've done, not what you can do. That's what the banks underwrite off of, and that will confirm that's what the private equity companies are looking at when they're applying their EBITDA and their multiples. And again, he'll talk more about that. They will consider future growth opportunities, but it's not nearly as robust as, say, a tech firm where they're going to assume, hey, this is going to grow from 1,000 users to 100,000 users.
Right.
So from that perspective, and it's more prevalent in the private sale, you have all this buttoned up and put on paper and categorized for it to be counted in your valuation. No bank is going to give you credit because, we could place 20 plus implants here, but we just don't. The banks aren't going to give you additional consideration for that. You have to actually do it. Or, we could cut our supplies in half, but we just use this really high expensive supply company. If you want to get credit for it, it has to be in the financials and it has to be logged. So the most important thing is, again, getting ahead of the curve there, getting the valuation ahead of time, bookmarking where you're at, and then creating a plan to get where you want to be.
It sounds like the TLDR version, right, is basically chat with these guys early, chat with McLerran and your advisor early. You mentioned, I literally had this week about, we could do this, we could do that. And I'm like, it's great. I'm not a broker, but generally buyers aren't buying on a pro forma, right? Like you said, if you're pre-money, it's going to be hard to get that $2 billion valuation, right? So let's, talk to the folks you need to talk to, the financial folks, put those corrective measures in, and then, hey, 2 years later, it's 18 months, right? It goes by pretty quick. If you're doing the right things, then you can tell a better story. Matt, on the DSO side, what do you think?
Yeah, one thing I would just add in the private side, just for Andrew, is, and he knows this obviously, but your bread and butter dentistry practice, doing that $1 million in revenue, and then you have an AEGD come in or like a GPR come in, they'll pay that. They'll pay that, or they'll look at that because they can come in with that expansive clinical procedure set once they buy it and really, the gas on. So just something from an individual, buyer standpoint, don't be afraid of a little bit more of a rural market where you can come in as a dentist and have all these expansive procedures that may not have been available in the past. So, you're going to pay a higher value on the private side. And I think Andrew would agree to this, is in those higher metro areas where it's more desirable to live, but you're going to have a lot more competition. So don't be afraid to look in the suburbs or in maybe a little bit more of a rural area, because there's a lot of good cash flow to be had in some of those more rural areas. And I think that's where dentistry as a whole on the private side and on the DSO side is slowly migrating away from those. Those rural practices are a little bit more challenging. Moving into the DSO conversation, you nailed it, Justin, right? There was a white hot movement going on from about 2020 to, late 2023 when rates started to tick up. And, obviously there's a lot of people that say, cost of capital was free flowing and, money was just going, and it was, right? And it was. And there's this big thing. Everybody says, if capital was, back where it was, things would have never taken a hit. I don't necessarily think that capital was 100% what's restructured some of the DSO. I still think that there's a lot of very well-run operating businesses that are insulated from the cost of capital, right? I think that cost of capital, could accelerate growth, But I don't believe that cost of capital is the pure indicator as to why some of these DSOs have had some trouble. I think it was, you could go out and aggregate very easily without having a proven, regulated, operating structure, and just go out and buy things, hoping that you were going to, turn around and flip that DSO over in a few years. Where a lot of the very strong DSOs, the cost of capital, it didn't affect them, at all, like from an M&A standpoint anyways, maybe from an operational standpoint, or maybe slowed things down. I do believe to some degree that, sure, cost of capital, I do believe that it slowed the roll-up of dentistry down. And I think that I think we're in this kind of this middle area where there's a lot of talk about, the DSOs are going away, and there's so much private equity money in the space already that I don't think that DSOs are going to go away. I think they'll be forced to operate and run in a different capacity. I think that it has made operators prove themselves more than they've had to in the past, where I think you're seeing regulatory stress testing. Some of the states are starting to pass some of that. I'm not going to get into all that today. Obviously, I'm not an attorney either, so I think some of it's yet to pass. And so that has passed, I think it's yet to be implemented, and so on and so forth. But, look, DSOs and private equity serve a very good channel within the dental space, right? So you have a $5 million practice where you've given the opportunity to buy it or buy in, and they don't want to take on that, $4 million in debt that it's going to take to buy it, or the $2 million it take them to be a large percentage holder in the business. Well, the options for that sellers are going to be somewhat limited, and they're going to have to find the right partnership, whether that's, some form of DSO or some form of sale. It's still there, and it always will be there. You have to think of I look at it as kind of like the tides, right? Like a wave comes in and pulls back up. That's startup dentistry all the way through DSO, right? And the whole life cycle of the business. I just think that DSOs entering the space, I think also put a spotlight on a couple of the different things. One, the operational capacity of dental practices, and COVID, let's be honest, COVID was a huge catalyst, right? Staffing challenges, the little bit older boomer hygienists retiring during COVID, in certain markets like the Mid-Atlantic, like trying to find a hygienist up there is, it's very competitive. So I think that there's a lot of things, perfect storm, that came in during the private equity movement. You had early DSOs came in, cost of capital was lower, COVID hit. I think COVID was a big catalyst in a lot of practices rushing towards DSOs, the unknown. And I think that we're starting to see some of the aftermath and the settling out of that, almost like a little bit of, we call it a hangover, maybe just a little bit of the industry hangover. But again, I think that private equity very much, it will continue to serve its purpose. One thing I will say about market conditions, maybe that, is something to consider and look at would be, I think Brandon, our principal, says this best. They're from the Houston area, and they talk about the beach houses down on the coast. And when a hurricane comes through, you have some that are completely wiped off, their houses that are completely wiped off their foundation, some that show, a wall's missing or this or that, need some work. You see some that have just a little bit of cracks in the foundation. Then you have some that weren't touched at all and are ready for more growth. Take advantage of the situation, put the next level on the roof, and all the things. And I think that you're seeing some of that from how aggressive, and look, the amount of DSOs that entered the space from 2020 to 2023, right? So I think that you're just starting to see some of that settle out. Unfortunately, there were some bad actors that probably had no business aggregating and owning dental practices. But again, I think that that's also having the right sell-side advisor in your corner and showing you the optionality and making sure that you understand the risk of the individual potential partnerships, but also understanding what your appetite for risk is on the front end, so that you're in front of the right groups. And we work with mainly only the top performers in the DSO space, unless the doctor is just, hey, I want to get in on an earlier platform, I want to have a stronger equity position. This is, that's what it's more palatable for me. So there's optionality all across the board from a risk tolerance on the DSO side. Does that answer?
Yeah, that makes a lot
your
of sense.
question?
That makes a lot of sense.
Yeah.
And I think that, nobody here is a crystal ball. Matt, Andrew, maybe you do. I don't. But, next 12 to 24 months, you guys see kind of more of the same. I mean, Andrew, it sounds like things are continuing to look up, right, on the private side. And, interested if you see conditions looking similar, into 27, maybe 28, barring something that, we don't see coming.
Yeah. I mean, I think Right. We don't have a crystal ball. We don't know where interest rates are going to go. If I could predict interest rates, I'd be working at a hedge fund, not at practice brokerage. But if I could give my 2 cents on the subject, I think both markets are still extremely robust and healthy. At the end of the day, the private markets are still operating at a peak of historical levels. You've never been able to sell your practice for such a valuation in the history of practice sales. The DSO market multiples are still strong for, again, high quality offices and top MSAs, the practices that these groups want to acquire, right? I would say that the overall buyer demand on the DSO side has not waned. It's just become more scrutinizing. They have to make sure that they can integrate. They have to make sure that the practices actually make sense for them. There's no more stretching for the borderline practices, right? And then we can talk more about that on another podcast because that's a whole discussion. But I think looking forward, I think where we're currently at is either going to be the secular trend that we see continuing, or it will ease as interest rates come down and as the economy kind of reopens up in the private capital spaces. I think ultimately when you are in turbulent times as of now, right, where both options can work, there's a lot of change going on in the space, and you need to make sure that you're aligning either on a private sale that makes the most sense for your retirement plan, or with a DSO group that actually, where the equity has value and where you can actually navigate that space and to have a successful outcome, whether that's in 3, 5, 6, however many years in the future. You need someone who can help you navigate that turbulence, right? Back in 2021 and 2022, there were a lot of people who I would say, in the investment world, we would call them DIYers, do-it-yourselfers, who could get away with trading their own portfolios because the markets were just so strong. It didn't really matter. If you put money into the Mag 7, you outperformed your average advisor. But when you get into turbulent markets where the S&P 500 is not growing at 20% per year and Mag 7 or these other tech stocks are not having double-digit returns, that's where the strength of an advisor and a diversified portfolio and seeing your optionality is extremely important. And the same thing goes for dentistry, right? When you can get 8, 9, 10x and it's just a complete money grab. And like you said, a gold rush per se, it's really easy to still navigate a successful deal and really not leave that much on the table. Now the opportunity cost has grown. Affiliating with a group that's not the right fit or whose equity, potential is not nearly as robust as to say it was in 2021 or 2022, you are more prone to fall into that pitfall. So having someone to help you, again, sift through the noise, get through the fog, and actually find that right outcome and that right group or that right buyer in the private space is more imperative than ever. You have someone who can kind of help you navigate these processes. Otherwise, the odds that you end up walking a path that you don't want to walk are that much higher.
Yes. Said Andrew. Same in the DSO space, right? I think that, just understanding back to the risk tolerance and what you're looking for and defining your real why is what you're going after is imperative while going through this process and trying to figure it out. As far as the future, I don't know, Justin. Your guess is as good as mine. Capital could unlock and all of a sudden dentistry could be perceived as the number one investment again in the healthcare space. And all of a sudden, your massive recaps are happening and all that. I think also, the multiple conversation is an interesting one. I think that, the multiple, it's more important to understand what your true EBITDA is and work with a group that really can help you hone your EBITDA and make sure that it's defensible so that you understand what that is. Because let's be honest, private equity firms have teams of analysts that are going to go in, or quality of earning firms that are going to go in and attack the EBITDA and try to erode that EBITDA, which ultimately erodes value. I always use the analogy of, any sell-side advisor can go out and say they're going to get you a 12x. Well, a 12x of what, right? So a 12x of 100 grand is the same thing of a 6x of 200 grand, right? It's the exact same thing. So it's protecting and understanding that EBITDA is more important than anything. And that's where I think our strength as previous bankers as a team and having a CPA on staff and having us fully, we have a fence around our entire firm where nothing is outsourced, I think is a huge or win an opportunity for McLerran and Associates, potentially over some other advisory firms where they're outsourcing the, valuations and so on and so forth. Just making sure that you know what your EBITDA is and you can understand that with your advisor. I think that's so important.
I think we have a whole another episode just about the valuation discussion there, because I know I mentioned this to you guys kind of in pre-show, right? I'll get a call from clients. What are you seeing for valuation? What do you see for multiples? What do you see for multiples? And I literally, like multiple of what? It's really, this guy got a 12x, this guy got a 9x. Again, I could dangle these numbers all day long, but what do they really mean, right? And at the end of the day.
The problem is the inconsistency in how those multiples are quoted, right? Are you counting earn ups or other deal consideration that, would normally not be quoted as an EBITDA multiple, right? Versus just the true actual value brought to the closing table. Yeah, it's easy to get 12 million. Oh, I got a 12x, but they include a bunch of earn-ups that are, essentially unattainable because they require you to grow your EBITDA by 50% in 2 years, right? The quality of the deal structure matters so much more than the face value that's being quoted. And that's why you need someone, again, who's familiar with the letters of intent, the deal mechanics, to be able to explain and normalize everything. So that way you can actually make an educated decision. And the best example, I have a case study right now where I have a deal up in the Midwest where the advisor comes to me, hey, this is a $17 million offer, but it's based off of 5x returns on equity over the next 7 years. And the EBITDA is 400,000 below where I calculated it to be. And that's a doctor who's not working with a broker. They're getting directly solicited. And so again, we could talk about valuations on the next episode, but there are so much confusion and noise when it comes to the DSO space. And if you're not educated and you don't have someone who's familiar with navigating this terrain, it is very easy to get, to run off the road. Very easy. And once you're off the road, it's hard to get back on course.
Yeah. I think in addition to that, I worked with that case study with Andrew, and in addition to that, and all the different things with the EBITDAs and performance metrics, the other thing was they wanted to pay the doctor about 10% lower than what market comp is. So they not only were getting it, in the valuation side and the earnouts and earn-ups, they were also looking to comp the doctor lower on the front end as well. And so just knowing what market comp is, I think is so important. I also think, going into the future, I definitely believe you're going to see more deal scrutiny on the front end of the deal, Justin, in the DSO side. So you're certainly going to see a lot more front end due diligence on deals, integration due diligence, financial due diligence, all the way up until LOI. Whereas before you saw more of how fast can we lock this down with an LOI or worry about it post LOI. I think you're seeing a lot more scrutiny and due diligence on the front end. At least I'm seeing it on transactions, which again is imperative that you have a good sell-side advisor that's navigated a lot of these transactions, because you may never get to LOI if you don't have somebody on your team that has handled a lot of these post-sale or up until sale, post LOI. So I think that's definitely an industry trend that's happening. So, making sure that you're working with somebody, that process is of high importance, because again, they'll just try to chip away at value as you go through that process. So I don't think that's going to slow down. I don't think that deal structure's changing. I don't think that that's going to slow down. For a long time, we just saw cash and equity. We're still seeing that, for the premium assets and what makes sense. But occasionally, we're able to negotiate earnouts or earn-ups, and we want to make sure that, enterprise value stays sound all the way through at close. So again, it's definitely, we're seeing some changes and some headwinds, but it's still, for the right assets in the right markets, it's still a very strong market.
Matt, you bring up such a great point too. And this is also true for the side advisors, and the knowledge of buyers is growing at a rapid pace. It is no longer a buyer just comes along, they're just willing to buy the practice, they're uneducated, they don't understand how the financing system works. Buyers are more educated than ever before, and they're more scrutinizing than ever before. If they're going to take out $1 million loan and buy your practice, they are reviewing the financials. They are doing more upfront due diligence before submitting an LOI in some cases. You have someone who can defend your practice, defend the valuation, and own the information by handling all of this in-house. Otherwise, you are susceptible to being, essentially not being able to transact. You just don't have the ability. If you can't defend and you can't communicate value, then your value is subject to essentially default risk, or not default risk, but it's subject to devaluation is probably the right word. So being able to have someone who can roll up their sleeves, understand the clinical, financial, and operational aspects of your business, so that way when they do determine the valuation, it's defensible. That is not just holding true in the DSO space. That is also very true for the private space nowadays too.
Yeah, I think you guys both mentioned this, the diligence, just again, anecdotally, like last year, we saw deals, add another 30, 60 days early on, right? Just in diligence. And we're still seeing it. And I'm like, where's the legal docs? Where's the legal docs? Let's get moving on legal. And a lot of times I got like pump the brakes, we're still working with Q of E and going through our process to make sure, and even more legal scrutiny, right? Like, hey, normally it was any liens, liabilities, let's talk about that stuff. But, I've seen requests now for contracts with vendors and like scrutinizing some of that, which I didn't really see much of before in the legal end. It's been interesting, telling of the times.
Yeah.
I mean, legal diligence also has gotten more intense, right? Making sure that those disclosures are filled out with complete accuracy and, like you said, vendor contracts. And I mean, look, on the private equity side of the business and really on the buy side of the business, in an individual buyer, in my experience, they're a little more fearful. It's their risk to go to the bank and get the money. On the DSO side, they want to see growth. Where can they pull levers to grow the individual practices, whether it's vendor contracts, like you mentioned, or, renegotiating provider contracts with, different PPOs or so on and so on and so on. So I think no matter what, we've kind of just said that there's a lot of scrutiny that goes into these deals. There's a lot of popping the hood and looking at the battery and the engine and making sure everything is the way that it should be. And having the right person with you while you're going through all that, I think is to simplify it, I think, in closing here would be the thing to say. With that, if it's okay, I'm going to give a shameless plug, Justin, if that's all right, real quick.
Yeah, do go for it. Now's the time.
Yeah, dentaltransitions.com. Would love to do a free consult. We do discovery calls daily, all of us. I want to be clear that, Andrew and the firm, we all operate as a symbiotic team. There is no really private side or DSO side. We work together. So nobody at McLerran is ever incentivized to do the wrong thing and push a doctor in one direction or the other. Make sure that we put that across, right? I want to make sure that, it really comes down to workload and capacity. Andrew will occasionally handle some of the private equity DSO stuff with some guidance from some of the more senior executives in the firm. And then, I'll handle sometimes some of the more premium private side assets, depending on geography and workload with Andrew. So just want to be clear with that at McLerran and Associates, you get a full scope all the way across from private to DSO sides, all objective. There is no one side or the other. Andrew and I run as a team, pretty much operating up and down the entire East Coast. So yeah, dentaltransitions.com, Matt at Dental Transitions, Andrew at dentaltransitions.com. You can easily email us, go to our website, fill out a form. We'd love to work with you and do a discovery call and maybe give you some guidance as to what the future might look like for you.
Love it. We'll throw it all in the show notes so everyone can get access to that. Guys, thank you. Well, we're definitely doing a round two because I can listen to you two go on all day. So this has been really helpful, really informative, and I appreciate the time. So thank you.
Yeah, thanks for having us.
Thanks for having us, Sutton.